Hola Econ peeps. Time for Module 13. I do apologize. This is a little later than I would have intended. I would have done it last weekend. I've spent the last couple of weeks a little under the weather. My voice may still sound a little funny. I will still cough from time to time. Excuse me. But I'm definitely improving eventually, hopefully. So let's dive right into Module 13. We're going to talk about monetary policy. I have to tell you, I am not happy with this content at all. I had to use it. This is what was required by Ranger College. Fair enough. I've made do as best I can. But for me, this chapter really breaks the bank. They do such a bad job of explaining monetary policy. It's absolutely epically tragic. And it should not be allowed in education, in my opinion. But I don't get that input. So I won't be using it again if I can help it. I've already let them know that I will be finding appropriate content for my college class because this is pretty bad. And you'll see some of the things I'm talking about here in a minute. All right, so let's go ahead and dive in and talk about some monetary policy. All right, so again, just as a reminder, give me a second. All right, before we go too much further, I just want to, I think I showed y'all this, but I want to remind everybody, right? So I call this the fundamental equation of macroeconomics, right? And we've talked about this ad nauseum, right? This equation right here. C plus I plus G plus NX. And NX is net exports, which is X minus M. Exports minus imports. Okay? So this is important because we talked about fiscal policy. Fiscal policy primarily affects consumer spending by changing taxes and government spending by changing government spending. All right? So the C&G is primarily affected by fiscal policy. Fiscal policy is set by the legislature. It's consumer spending by, if you change taxes, right? If you increase taxes, consumers have less money to spend, lower C. Okay, less consumer spending. It also affects government spending directly because obviously they increase government spending, decrease government spending. The legislature sets those spending rates. And if you reduce government spending, lower G. Boom. You increase government spending, higher G. Boom. All right? Taxes kind of work indirectly. You raise taxes, consumers have less spending, lower C. You decrease taxes, consumers have more money to spend, you increase C. Now, monetary policy is primarily business spending. So, and then net exports is something called foreign exchange, and we will talk about that at the end of the semester. Forex. Okay? And this is important because remember, the main model we've been working with here lately is something called the aggregate supply, aggregate demand model. All right, with price level on my vertical axis, output on my horizontal axis, an upward sloping short run aggregate supply curve, a downward sloping aggregate demand curve, and for good measure, I will go ahead and put in the long run aggregate supply curve and suggest that we are at or near long run equilibrium, what we call full employment output. This should look pretty familiar to you by now. All right? Now, why is this important? How does this relate to that? Well, guess what? This Y on the horizontal axis is the same as this Y here. All right? So, you change any one of these, you change this. And remember, there's a multiplier effect. You raise taxes, giving consumers less money to spend, which also can affect businesses, by the way. But those are two very distinct. Changing taxes does not automatically change tax for everything and everybody. All right? But changing taxes can certainly affect businesses. Typically, not always, but more often than not, most of those businesses pass on the additional tax burden to the consumer in the form of higher prices. All right. So you change any one of those. You increase taxes, consumer spending goes down, output goes down by even more. Aggregate demand collapses by even more. Right? You decrease taxes. Consumers have more money. C goes up. Y goes up even more. Aggregate demand curve shifts to the right even further. You increase government spending. Y goes up by even more than that, by the multiplier amount. All right? So remember, there are 3 multipliers that you're gonna learn. You're gonna learn another one here coming up. Okay? Should have, probably in the next chapter, the next module. So let's go through those real quick. There's the spending multiplier. That's the one you've already learned. That's 1 over the marginal propensity to save, and because we either save or consume 100% of that additional income, that's what marginal means. That additional income is either going to be spent or saved. Okay? And so you can also do this as 1 over, in other words, the sum of marginal propensity to save and marginal propensity to consume has to be 1, or 100% of that additional income. So you could also do this as 1 over MPC minus 1. That's your spending multiplier. So they increase government spending by $5,000, and you have a multiplier of 5, right? Which would be a marginal propensity to consume of 0.8, pretty common. Multiplier of 5. That means if you've increased government spending by $5 billion, your total output can increase by as much as $25 billion. 5 times 5. All right. Then there's a tax multiplier. We don't really deal with this too much, but it's out there, right? And it's the ratio of your marginal propensities, right? It's the ratio of marginal propensities. Now, in our last example, I said 0.8 was the marginal propensity to consume. That means marginal propensity to save is 0.2. And that is 4. Now, if we do it up here and we say 1 over 0.2, that's the same as 10 over 2, or 5. Well, look at that. The tax multiplier happens to also be the spending multiplier minus 1 at all times. So your tax multiplier is just 1 less than whatever your spending multiplier is. In other words, if they increase taxes by $4 billion, total spending is going to come down by $16 billion. They increase taxes, you have less money. How much less? As much as $16 billion less to spend in aggregate. Okay? The other one that you're going to begin to learn some of today, not all of, is called the money multiplier. And you won't know what this is yet, but that's 1 over the reserve ratio. All right? And we will learn more about that here coming up. Okay? So bear with me. Sorry, just wanted to do a kind of a quick review and remind you of what we're talking about here. This module does not mention, to my knowledge, doesn't mention multiplier at all. I'm hoping that will come up in the module 14 policy applications module. If it doesn't, then it's a staggering oversight, which wouldn't surprise me as bad as this has gotten. And I'll explain more. The Fed uses 3 main tools. No, it doesn't. It uses 4 main tools. This module completely eliminates the policy choice that the Fed has been implementing now for more than a decade, since the financial crisis. There has been an additional tool added, and they've done that almost exclusively for more than a decade now, to the exclusion of all other policy tools. And it's not even mentioned here. It's, again, just an unbelievable oversight. A frighteningly, another frightening example of what I consider to be just utter dereliction. Sorry, I don't mean to get on my high horse here, but it's aggravating. This is not trivial to me. You may not think it's important. I think it's important. I think what we tell the students needs to be accurate. And I think the information they give us to present to you should be accurate. And when it's not, it's a bad reflection on the education system that I'm a member of. So how does the Fed affect monetary policy? Well, by implementing one of these 4 tools, and we'll talk about all 4, despite their best efforts to hide one of them shortly. But what it's going to do is it's going to affect the supply of money. They are changing the supply of money. How do they do that? By changing interest rates. Let me rephrase that. They're going to change interest rates by changing the supply of money. All right? In this case, it's something called the loanable funds model. You'll see that in a little bit. All right? It was one of the 2 models I talked about that affect interest rates. Okay? So, and it's a pretty straightforward model. Not a bad one at all. I like it because it's just straightforward supply and demand. All right? Let's go ahead and make this big so you can see this easy. And there's my loanable funds model there, right over here. All right? That's loanable funds, and that's interest rates. If you affect the supply or demand of loanable funds, you affect the interest rate. 2 ways to think about that interest rate. Remember, I've told you this already, but it bears repeating because it can be hard to remember all this, right? Interest rates serve. There's two ways to think about interest rates, both of which are accurate. Interest rate is the cost of borrowing money. That's why it primarily affects businesses. I'm not saying consumers don't borrow money, but the amounts you borrow in aggregate compared to how much businesses are borrowing in aggregate, 2 very different things. Very different things. So typically, that's primarily going to adversely affect business borrowing and therefore business spending. Lower I, lower Y, higher I, higher Y. And remember, that Y is going to increase by even more. And this time you're using a money multiplier to determine how much, but we'll get into that. So that's one of the ways interest rates affect the economy. It's the cost of borrowing money. But there's another way. It's also the opportunity cost of current consumption, isn't it? Right? Because instead of spending that money, couldn't you save it and earn an interest on it? So it's very much the opportunity cost of current consumption. And in that way, a higher interest rate incentivizes savings. Right? Because you can make money saving your money with interest. Also hedges you against inflation. If you're planning on holding money for a while, and in a down economy, we do sometimes that depending where you're at in the socioeconomic scale, that's sometimes what you do. You want to hedge against inflation, right? You want to protect your liquid assets against the erosion of its purchasing power, right? You don't want inflation to eat away at the value of your money, and that's what it does every single day. And with high rates of inflation, that's bad. So you want to sock it away so interest rates will keep it up. It doesn't say this that I've seen yet, but there's really 2 parts to your interest rate. There's what we call nominal and real interest rate. And it's really not the same kind of distinction that we had with nominal and real in other areas. But there's a part of your interest rate that is meant to offset the erosion of your purchasing power, i.e. inflation. So there is some part of your interest rate that is meant to be sure they're going to estimate over the life of this your deposit or this loan they make you, how much do they think inflation is going to be over that time frame on average. And they will charge you an interest rate either for depositing your money in their bank, they'll give you this interest rate, or they'll charge it to you as an interest on your loan. That's going to be at least however much they think inflation is going to be over the life of that loan. That's why if inflation turns out to be higher than what they anticipated, then you're effectively paying the loan back in cheaper dollars. If it's a savings, then you're losing your money, at least some of it. You're not holding on to as much of it. See what I'm saying? So, the second part of keep in mind it costs banks money to make loans. It costs them money to make loans, right? And so part of the interest rate is this additional cost, plus a little something extra for their trouble, right? Somebody has to process the loan paperwork, and that's the people doing that. Their time is valuable, has some value at least. They have to have power, and people have to come in and clean the banks and all that stuff. All that, bank tellers, presidents, all that, those folks that manage that stuff. That costs money, right? So, interest rate's going to be made up of anticipated inflation plus what we call it real interest rate, but it's really just to cover the cost of the bank of making the loan, plus a little something extra for their trouble. Right? So keep this in mind. This is how interest rates are working. We're going to be changing interest rates by changing loanable funds. All right, by changing the money supply. This is effectively the supply of money. It's just another way of looking at money supply. All right, this one we call it the loanable funds market. This is money that's available in a bank somewhere that they can borrow. Hence the name loanable funds, right? And so if you increase the supply of loanable funds, you drive down interest rates. If you decrease the supply of loanable funds, you increase interest rates. Similarly, if you increase the demand for loanable funds, you increase interest rates. If you decrease demand for loanable funds, you decrease interest rates. So they set monetary policy specifically geared towards changing the supply of money to affect interest rates. And we'll talk about how they do that in this chapter. Some of it, right? All right. So some of the definitions. We'll have a couple of slides that'll talk about the different kinds of words that you need to know in this module. Financial contagion. When there's concern that a bank is insolvent, that can spread to other banks that they may also be insolvent, and this can lead to bank runs, right? Where people rush to the bank to get their money out, thinking the bank's about to go belly up. It hasn't happened too often in the last 100 years, but certainly happened in 2006. It happened in 29. And back then they didn't have deposit insurance, and so they just didn't have their money. They were out of the money. People put money in the bank and lost their money, lost their life savings. It was in the bank, and the bank didn't have it anymore. Illiquidity is when the demand for cash by depositors, people put money in the bank, that's a depositor, exceeds the bank's available reserves. So if you put your money in the bank and you go and try to pull it out, they may not have that money in reserve. They may not have that money readily available in the bank, and that would make the bank illiquid. Insolvent is when the value of the bank's assets is less than the value of its liability. It's basically a bankruptcy, right? All right. So banks earn income by making loans, as I just described. Excuse me. But they make safer investments. They buy treasury securities, which are IOUs. I think I've described these before. T-bills, bonds. Those are all the same thing, really. Banks are a part of a much larger financial system, and it's really acts as the sort of intermediary between. It's kind of the person between the producer, or at least the seller and the buyer. They act as kind of the liaison. The reason why the buyer can trust that your debit card is going to result in that money being moved to their bank account is because the bank says it will. Savers supply the funds for borrowing. Borrowers provide the demand. All right, so it's a balance. The supply of loanable funds comes from people who put their money in banks. So when you hear people talking about, the wealthy are hoarding their capital, no, they're not. Unless they're burying it in their backyard or they're putting it under their mattress, they can't. They're putting it in a bank, and guess what happens? The bank uses that to loan out to other people who are in need of it. Sorry. Yet another sacred horse has been slain. Sacred cow, not a horse. Anyway, savers supply the loanable funds. Borrowers demand the loanable funds. All right? So, and the interest rate determines, at least in part, has an effect on demand for interest rates, as well as the supply, demand for loanable funds, as well as the supply for loanable funds. Higher interest rates reduces the demand for loanable funds and may increase the supply of loanable funds by creating an incentive to save rather than spend right now, because you can earn more money on higher interest rates. Okay? So if your bank is solvent, it could attempt to raise cash by selling assets. Unfortunately, those kinds of fire sales usually result in you're not going to get your full value of the asset, and they're not going to make enough to cover everybody's deposits. So it may not be enough to pay off those depositors. Bank runs are based on emotion as much as logic. Can try to borrow from other banks that are maybe better off, but when you got widespread bank runs, then that becomes an issue for sure. All right. The central bank, our Federal Reserve Bank, they conduct monetary policy. They are not government. They are quasi-public at best. They were created by the government, but they are independent. They do not have to answer to Congress in any way, shape, form, or fashion. They don't have to answer to the president in any way, shape, form, or fashion. but they are appointed by President and Senate gets to confirm. Oh, well, so much for independence, but that's the way that works. And there's a 7-member board of governors, right? There's the chairman of the board, and that's there's the president of the New York Reserve Bank, because there's 12 banks around, regional banks around the country. If I'm not mistaken, the president of the New York Bank always serves on it, and then the president, the chairman of the Federal Reserve, which is appointed by the president, and then there are 5 other bank presidents that rotate through at various times to serve on the actual board of governors. And the board of governors are the ones who set monetary policy. They make the choices and decisions. That's 7 people. Okay? And there's the breakdown of the 12, right? We have one in Dallas. I've been there. I've presented a paper there. Applied for jobs there and didn't get them. No. A long time ago when I first got out of college. That's all right. Water under the bridge. I better know ill will. So there's the 12. You can see where they sit. Okay. Yeah, I don't think all 7. No, that's not. Yeah, 7 members are appointed. That's true. All members are appointed by the president. The United States Senate confirms. So, what are the primary purpose of a central bank? First and foremost, they set monetary policy. Period. The government does not set monetary policy. The Federal Reserve does. The government gets to kind of tinker around the edges in some ways. We'll talk maybe some about that, but generally speaking, it's pretty much left to the purview of the Federal Reserve, the central bank. They do serve other purposes. Their primary purpose is monetary policy, but they also help to ensure the stability of the financial system, we hope. And they're also a lender of last resort. They are a lender of last resort, which we'll talk about as well. So we regulate banks. It's the goal, of course, is to reduce insolvency, right? By discouraging banks to take on excessive risk, like they did in the 2008 financial crisis and had been doing for the decade prior to that. Absolutely. Oops, we failed at it that time, didn't we? So there's different ways that the government regulates banks. So really, the Fed sets the reserve requirement. Now, forgive me, I'm going to have to get a little wonky here on you, okay? Our banking system operates under what's known as a fractional reserve banking system. What that means is that a fraction of every dollar that gets deposited into a bank has to be held by that bank. They have to hold on to it. All right? That's known as their reserve requirement. If the reserve requirement is 10%, then and you deposit $100 in their bank, they can loan out 90 of it, but they have to hold on to 10 of it. And every single day, they have to meet this reserve requirement. If they fail to have the correct amount of required reserves at the end of the day, they have to find a way to get them. 2 ways. They can either borrow from other banks that met their reserve requirement and have what we call excess reserves, additional reserves. They can borrow that money from them. And they are charged what's known as a discount rate. The discount rate is is an interest rate on the short-term emergency, typically overnight loans that a bank with excess reserves makes to banks who did not meet their reserve requirement. They can also borrow from the Fed. Remember, I told you the Fed acts as a lender of last resort. I realize that's not what they said in this slide right here, but who cares because they're goofy, right? That's what it is. They're a lender of last resort, okay? And they also will loan banks to be sure they meet their reserve requirement. They too charge an interest rate. We're going to talk a lot about this one. This one's known as the federal funds rate. I have this backwards. I'm so sorry. I'm so sorry. The federal funds rate is the rate of interest banks charge one another. The discount rate is the rate of interest the Fed charges for these loans. My bad. I apologize. All right, let me repeat that. I have this backwards. The discount rate is the rate of interest the Fed charges on these short-term, overnight, emergency loans so that banks can meet their reserve requirement. The federal funds rate is the rate of interest banks charge one another for the same kind of loan. So banks that have excess reserves can loan some of that money to banks who didn't meet their reserve requirement, and they get what we call a federal funds rate. It's the rate of interest charged for those loans. My apologies. Got them backwards there. Discount rate is the Fed. The federal funds rate is the other banks. You would think the federal funds rate would be the Fed, would be the rate charged by, the Fed? But no. For some reason, the federal funds rate is the one by banks. The discount rate is the one by the Fed. So I apologize for getting that mixed up. So, reserve requirements. I don't know what they mean by capital requirements. There are no capital requirements. I have no idea what they didn't define capital requirements, and nobody else has ever called it that, unless they mean excess reserves. I don't know. Just some weird nonsense that only these folks made up. Restrictions on the type of investment banks can make. That's certainly true. So bank capital is the difference between the value of their assets and their liabilities. And they have to maintain a minimum net worth that's usually some percent of their assets that will protect depositors and other creditors. Okay? So, there it is, lender of last resort, finally. Because bank runs and the risk of bank runs can destabilize your financial system, Congress passed deposit insurance. It was $250,000 for the longest. My understanding is during the Obama administration and the financial crisis at that time from 08 to 10 roughly, they doubled that. Maybe it was 100,000 and he made it up to 250. I don't know. But anyway, that's certainly they insured deposits up to a certain amount. Okay? And again, the Fed acts as a lender of last resort to provide loans to distressed banks when the banks can't obtain credit from anywhere else. But they also do it for other reasons. All right. There's that discount rate. It's the interest rate charged by the central bank on the loans that it gives to other commercial banks. Okay? Then there's the federal funds rate, which is the interest rate on overnight interbank loans, the loans between banks. We talked about that. All right. So there's your monetary policy. All right. Changing the discount rate. All right. Think about this. If they said that they're going to charge you a higher rate of interest to borrow from them, that's going to create an incentive to not loan out too much money. So the bank has to keep in a certain amount, their reserve requirement. They can loan out everything else. If they loan out too much, then they can have to be stuck borrowing money from somewhere. Now, they don't know at the start of a day how many withdrawals they're going to have to make and how many loans are going to be made. They don't know that. So it's entirely possible that they can end up short that day or have excess reserves that day. That's not outside the realm of possibility. But if they know it's going to cost them more, if they fail to meet their reserve requirement, if they realize they're going to have to pay a big discount rate to borrow that money to get up to be able to close their doors that night, they're maybe a little less likely to make some loans that they would have otherwise made. No, we're going to have to reject your loan application. Sorry, we're reluctant to make that loan today. So the discount rate can affect that, right? Federal funds rate. They don't change. They don't change that. They target it. When the Federal Reserve is targeting a specific interest rate, when they're affecting the money supply to try to get the interest rate to a certain level, they are specifically targeting the federal funds rate. It turns out that the federal funds rate tracks really well with every other. There's lots of interest rates out there. Okay, there's an exhaustive supply of interest rates for all kinds of things. But it turns out that when you change the federal funds rate, almost all the other interest rates are going to change with it. So you are effectively changing mortgage rates and all other kinds of interest rates. So they target the federal funds rate. That's why it's on this list. They don't change it per se. They target it so that when they affect their money supply, it's changing. Another way they can affect monetary policy is by changing the reserve requirement. Right? If they increase the reserve requirement, in other words, if they require banks to hold more than they were, then banks have less money to loan out. right? And again, primarily that's to businesses. So now business spending is going to go down because they don't have as much money available to them to borrow. The supply of loanable funds just decreased. Interest rates went up. Creates a disincentive for businesses to borrow. Likewise, they could reduce the reserve requirement. This would mean that banks don't have to hold it in much. They have more money to loan out. The supply of loanable funds just shifted to the right. Interest rates come down, creating an incentive to borrow and spend. Right? Higher Y by even more than I went up. Average demand curve is going to shift rightward accordingly. But obviously, we don't want to change the reserve requirement. We do not want banks having to guess at the start of every day how much money they're going to have to hold on to. So we really don't screw around with that one. And we really don't change the discount rate much. For most of the Fed's history, our primary tool, reserve requirement hadn't been changed, to my knowledge, since like 92. We don't mess with it. The primary way for most of the Fed's history that they affected monetary policy was through open market operations. This is buying and selling treasury bonds, T-bills, securities, IOUs. All right? Pretend for a moment I'm the Fed and you are a commercial bank. I go to you and I buy bonds from you. The Fed buys the bonds from the commercial bank. The commercial bank, what am I going to give them in return for these bonds? I just said I bought them. What did I buy them with? My good looks? We're in trouble. Money. I gave them money for those bonds. I bought the bonds from them with good old American dollar. The banks now have more money to spend, to loan out. Banks now have more money to loan out, all right? Similarly, I could sell the bank, and the bank has to buy them. I'm the Fed. I regulate you. I'll tell you what you do. So now I'm going to sell you these bonds. Here you go. Here's a bond. Take it. It's yours. Got to take it. What are you going to give me in exchange for these bonds? Money. I just now took money away from the commercial banks. They have less money to spend, to loan out. In other words, the supply of loanable funds just shifted leftward. That is the primary way we affected interest rates. That is how we affected the supply of money. That is how we caused interest rates to change. Because if we buy, they get more money and the supply of loanable funds shifts to the right. And a rightward shifting supply curve means interest rates are going to go down. Lower interest rates create an incentive to borrow more money. Similarly, if we sell bonds, the banks are giving us money in exchange for these bonds. It's an IOU. We're good for it. But in the short term, you won't have that money to loan out because you gave it to me to buy these bonds. Supply of loanable funds is going to be less, shifting leftward. A leftward shift of that supply curve means that interest rates are higher. Higher interest, disincentive to borrow. For most of the Fed's history, that has been the primary mechanism by which we affected interest rates, money supply. Here was the problem. So back in the 50s and 60s and 70s, there were some economists who argued that it's not fair to require banks to hold on to a certain amount of money. There's an opportunity cost associated with that. They could be earning interest and loans off that money, and now they can't earn anything because the government just told them no. You're not allowed to. Blech. Well, some economists said that's not right. That in order to offset the cost of the banks of not being able to borrow that, the Fed ought to have to pay them interest on their excess reserves, right? On those required reserves, excuse me. Or excess. No, yeah, excess. We'll go with excess. Bear with me. They're going to have to pay interest on those excess reserves. Banks get a little skittish about loaning out too much. They might turn down some loans that they would have otherwise made. Now they got those excess reserves sitting there, and they can't make any money off of them because they were worried they weren't going to meet their reserve requirement because of the Fed. So that creates, there's an opportunity cost associated with this. That is revenue the bank has lost because they didn't make that loan, and they didn't make that loan because they were scared of not meeting their reserve requirement. So we created something beginning in 2006. They passed a law that said they can start charging interest on excess reserves. That the Federal Reserve will start paying interest on excess reserves. It was not scheduled to kick in until 2011. It wasn't going to take effect until then. But then the financial crisis hit, and the Fed needed the additional policy tool. So they moved that day back. And in '08, suddenly, interest on excess reserves became the primary tool for the Fed for the next 10 plus years until the recent problems. Now we're back to doing open market operations, apparently. But that has not been historically the last 10 years what it's been. Interest on excess reserves. Excuse me. The reason why this works is because, again, if banks are not going to loan out their money at an interest rate that's less than the interest on excess reserves, because they'll be losing money. There's an opportunity cost again. They could have made more money by just holding on to the excess reserves and getting the interest rate that the Fed's going to give them for it. So this has been a very effective way for the Fed to keep the banks from loaning out too much money. Why do we want that? Well, it's not that we want it. But remember, we got a little money printing happy there for quite a while. Still are, arguably. And all that money going into the economy would just cause inflationary pressures. Gee, kind of like what we're seeing now, huh? But, so by doing this, they create a disincentive for banks to loan out all their money. It creates some incentive for banks to hold on to those excess reserves. Right? It kept them, but they wouldn't give them an interest that was high, that was too high. Otherwise, they wouldn't have any incentive to loan it out. But they certainly wouldn't charge an interest for any loan below interest on their excess reserves. That policy tool is not mentioned in here, and it is a staggering oversight and very unfortunate that they wouldn't put that. They've had a second edition of this book. They've had time to put that in. I don't know why it's not. Really, really embarrassing to me. Not to me. I'm not embarrassed by it, but they should be embarrassed if you ask me. All right. Yeah, this is one of those areas where this module does a terrible job of explaining this. Monetary policy operates through a complex mechanism, multiple mechanisms, in fact. The Fed supplies or withdraws reserves to the banking system. It's not really true. It's not really true. They don't always provide the reserves. Sometimes they discourage the bank from loaning out excess reserves. But that's not the same as giving them that money. That's just making them hold on to it or giving them an incentive to hold on to it more. But in the case of the open market operations, they really are kind of giving them the reserves or taking them away. If they sell them a bond or a security or T-bill, whatever you want to call it, then the bank's going to give them money for it. By the way, this goes also with the public. We can take money out of the public by buying and selling, or give them by selling them. We can buy it from a person and they have more money to spend, or we can sell it to people and they have less money to spend. The difference is people have choices. The banks really don't have much of a choice. When the Fed wants to sell, buy or sell a security, they're kind of obligated to do so. So in that way, the open market operations absolutely, you could argue, does supply or withdraw money from the loanable funds market specifically. So here again, 3 traditional tools: changing the discount rate, changing the reserve requirement, neither of which is really done. First off, they're both very passive tools. The only way changing the discount rate works is if a bank is prone to not meet its reserve requirement. If they don't ever have any trouble meeting their reserve requirement, lots of banks don't, then this really isn't going to affect them one way or the other, because they're never going to need to borrow from the Fed. Same with the reserve requirement. Maybe that only affects you if you're loaning out all of your excess reserves. But open market operations is now the primary way again, was for most of the history. There's one missing from here: interest on excess reserves. It should be on here. Interest on excess reserves is absolutely a tool that is now available to the Fed. They're not using it now, but they did for most of the last decade. Since about '08, they've been doing almost nothing but interest on excess reserves to keep the banks from loaning out too much of that cash. All right, so changing the discount rate. So the Fed has a discount window, right? Not the real window, but they could go borrow money from them to help avoid a bank run or collapse or insolvency from a bank run, right? If they need it. and they pay a rate of interest on the loans from the Fed called a discount rate. All right. Fed could raise or lower the reserve requirement. Again, I've explained this. If they raise the reserve requirement, banks have to hold on to more money. There's less money available to loan out. Less money, lower when the supply of loanable funds falls. The curve is going to shift leftward. Interest rates are going to go up. Distance you need to borrow. All right. Lower I, lower Y by even more. Aggregate demand will shrink. Shift backwards. That would be that would be what you might do if you have an inflationary gap. Okay. It says small changes in the reserve requirements are made almost every year. That's interesting. I have used a number of books in my teaching career to teach this subject. I taught it as an advanced placement course. I taught it as a college class. And I have never before heard this. So I don't know what they mean by small changes in the reserve requirement. I do know that they are limited by government statute. There are statutory limitations to how much reserve requirement can be, and it's based on how big the banks are. In other words, what's the total value of their total deposits. If it's less than 10 million, then the reserve requirement is going to be a smaller amount. But the more the more they have, it's kind of like a progressive tax rate almost. As the larger the bank, the more wiggle room they have to raise that reserve requirement. But they rarely do. They rarely do. I don't know what small changes are. But again, a sudden demand that all banks increase their reserves would obviously be disruptive. We don't want banks guessing. All right. Open market operations is buying and selling treasury securities or bonds or T-bills or whatever you want to call them to influence the quantity of money and interest rates. A purchase is the central bank buying treasury securities to increase bank reserves and lower interest rates. They sell, decrease bank reserves, raise interest rates. Open market operations. Not much new here. Other than, again, it targets the federal funds rate. The rate of interest the interbank loan rate, right? It says, we want this interest rate. So how much do I need to decrease the supply of money to get interest rate, the federal funds rate to go up another point, and that you can estimate using the money multiplier. Okay? It says decisions regarding open market operations are made by the Federal Open Market Committee. No, it is not. Decisions regarding open market operations are made by the Board of Governors, and the Federal Open Market Committee implement those decisions. They do not make those decisions. I don't want to get too much into the T-bill. I never understood why they put this in economics. This isn't an accounting class. If you're an accountant, this looks very familiar to you. If you're not, it looks very foreign to you. But the thing you do need to know is they need to balance. Assets and liabilities need to balance. 460, 40, 120 is 160, plus 300 is 460. You're in balance. All right? And your assets has to equal your liabilities net worth. And arguably your net worth is just your assets minus your liabilities. And if it's not, if your assets are less than your liabilities, then you're underwater and you're illiquid. You're going to have a problem. You could become insolvent. Not careful. Capital market, the markets for long-term financial assets. I really wish they wouldn't conflate the use of the word capital because we used it in other words. We've used it in the context of physical capital. We use it in the context of human capital. And now we're using it in the context of the more traditional sort of colloquial use as it relates to money and markets. And that can get confusing in economics. This is confusing enough without them adding to it. So I wish they wouldn't call it that, but they did. A contractionary monetary policy means they're going to reduce the supply of money, causing interest rates to rise. And that's what you would do if the economy was experiencing an inflationary gap. If you have a recessionary gap, you want to grow the economy. You want it to expand. So you'd have an expansionary monetary policy. I don't know why they call an expansion expansionary and a recession contractionary. Why don't they either call that a recessionary monetary policy or call the economic contraction a contraction instead of a recession? Federal funds rate, we've talked about. That's the loan made between banks overnight. The market for loanable funds, we've talked about that. We got that right here. We showed you. And the money market Again, this is the market for short-term financial assets. Don't worry too much about that. Yeah, oftentimes you hear the money market is what's described as the supply and demand for money. So they've narrowed that definition for these purposes, but and maybe to some that's all the money market means. But in my econ class, money market's really the liquidity model for interest rates, with that vertical supply curve for money, downward sloping demand curve that we talked about in the past. Prime rate is just the interest rate bank charged. It's really kind of the amalgam of all the other interest rates. But don't worry too much about it. When they change federal funds rate, prime rate's going to change with it. If federal funds rate goes up 2 points, prime rate's going up 2 points. And of course, everything else will go up at least some of that, not all of that. So, as you can see, there is a effect on aggregate supply, aggregate demand. So let's talk about this. This is kind of important, so I do apologize. I know some of y'all are probably rolling your eyes. Tech break. Can't help it. I'm a teacher. That's what I do. All right. I don't need red yet. I need black. Okay. So let's go start with loanable funds. All right. There's my loanable funds model. Right? That's what we've been talking about. Okay. Now, it did not show this, but there's something called the investment demand model. And I think it's useful to help understand exactly how monetary policy works. And this is quantity of investment spending demanded, right? Supply of investment, demand for investment, quantity of investment. All right. There's my loanable funds model with investment demand. You'll notice where that equilibrium is, it intersects right with the supply and demand for investment spending. Okay? All right, don't worry about long-run equilibrium. There's my ASAD model down at the bottom. You'll notice all this right here. There's my fundamental equation. This I right here is the same as this I right here. That is the same thing. So, contractionary. We've got some inflationary pressure in the economy. Too much money chasing too few goods. So-called demand pull inflation. We can fix that, right? We can increase the reserve requirement. We won't do that. We can increase the discount rate. We won't do that. What we will do is buy Treasury securities on the open market. And when I sell securities. When I sell banks securities, the banks have to give me money for those securities. They now have less money. They can't loan out a Treasury security. So they have less money to loan out. The supply of loanable funds has shifted leftward. All right? Causing interest rates to rise. Causing interest rates to rise. Well, let's see how that does. I'm now going to connect this line all the way across and see where my investment demand is now. You can get rid of that investment supply curve. That's not really part of that model. It just forced a habit that I drew a supply curve there. So I do apologize, but don't worry about it. Investment demand, downward sloping curve. That's what you need. And you'll notice what happened. Right? You will notice that the quantity of investment demanded has decreased. Lower I, lower Y. Lower I, lower Y by even more. That's going to cause my aggregate demand curve to shift leftward. Price level falls, output falls. But if this is traditional demand pull inflation, we're operating above full employment output. We probably need to come on down some. All right? In this case, I'll tell you what, I'm just going to go ahead and draw a long run aggregate supply curve and call it LRAS1. All right. And now we're at full employment output. Boom. Prices are lower. We're back in long-run equilibrium where we want to be. We could also, let's say we have a recessionary gap. All right, sorry, it's a little overlap, getting a little crowded here. But here's my LRAS2 right here, right there, and it's now my short-run equilibrium where ADAS intersect is it's now behind. It's lower than full employment output. We have a recessionary gap. Expansionary monetary policy. I'm going to go buy Treasury securities. I'm the Fed. I'm going to buy Treasury securities. What am I giving them in exchange for these T-bills that I'm buying? I'm giving them money. Banks now have more money to loan out. All right? Increase the supply of loanable funds. Here we go. And again, connected that to my investment demand curve. All right? So interest rates went down with this rightward shift. I've increased the supply of loanable funds by buying Treasury securities with my money, the Fed's money. Interest rates go down. Quantity of investment spending demanded increased. Higher I, higher Y. Aggregate demand curve shifts rightward, closing up that recessionary gap. Boom. All right? That is what we were talking about. That is monetary policy. We do contractionary monetary policy to close an inflationary gap. We use expansionary monetary policy to close a recessionary gap. Why can't we use either of those for our current situation? Because what nobody wants to talk about is our current situation is not traditional demand pull inflation alone. Certainly some of that. Certainly an element of that. But it is based on supply. Nobody wants to talk about this. The right doesn't want to talk about this because it undercuts their argument that the government's spending too much. Oh, run for your lives. And the left doesn't want to talk about it because, well, don't get me started. They don't know much about the economy to begin with. So, here we are. You cannot, neither of these are going to fix cost push inflation. And many people argue that there is no such thing as cost push inflation. Inflation is strictly a monetary phenomenon. That's it. It can only be caused by too much money chasing too few goods. Fair enough. You can call it whatever the hell you want. I don't care. All I know is when the aggregate supply curve shifts to the left, when you have an aggregate supply shock like we had 2 years ago with the pandemic because of the staggeringly stupid decision to close the economy, or because of oil crisis like we have with Russia and things going on. Oops. The average supply curve shifted hard to the left twice in the span of 3 years. Aggregate demand curve shifted hard to the right one time. Well, I mean, over time, one big leap. Of course, it's continued to move, but you get the idea. But nobody wants to talk about that. Nobody likes that. Even though I'd say probably 70 to 90% of our problem right now could be solved if we would just increase oil production. Nobody wants to hear that because we're all so worried about climate change, right? So it seems to me that they're knowingly and intentionally doing damage to the economy that most adversely affects people at the lower end of the socioeconomic scale. The very people they claim to want to help the most, they are hurting the most. It's going to be bad this summer. Not as bad here. But look what's going to be happening in Europe. Just stay tuned. Just keep watching. Watch the news. So we've already talked about this. I've showed you. Says Treasury securities held by private investors. I only did the banks. But it's not just private investors. It's banks and people and whatever. But however doing. If they're buying those Treasury securities from banks and people, from private investors, they are using money to do so, and that's more money out in the economy. Supply of loanable funds increases. I use banks because it's more intuitive, if you ask me. So we just showed this. So there's expansionary monetary policy with a rightward shift of aggregate demand contractionary monetary policy leftward shift. Counter-cyclical is econ speak for we're going to make something up so that we don't feel so bad about giving bad policy advice. Moving in the opposite direction of business cycle of economic downturns and upswing. It's a silly idea. They use this to deflate the debt so that it doesn't sound quite so scary. Quantitative easing is the process of buying a lot of these to make credit more widely available. We virtually brought interest rates to zero for the better part of a decade. So, in the 70s, inflation was high, again, because of that non-existent cost push inflation. But whatever you want to call it is irrelevant to me. It made prices higher and caused the economy to shrink. Called stagflation. By the 1980s, they got on top of this, and interest rates started coming down. Unemployment began to fall, and the economy boom began. And you can see how they used monetary policy to stop higher to increase federal funds rate to slow down inflation, and then for most of the 20 years, but prior to the financial crisis of 2008, we call that again the Great Moderation. We really had what we call disinflation, very low rates of inflation for most of that. Nearly 0% in 2009, and it stayed there for most of the time. All right. Hey, they did mention it. Hot dog. At the beginning of the Great Recession, the Federal Reserve found itself in a precarious situation. They tried a number of innovative initiatives, quantitative easing, alternative ways to increase reserves in the banking system. They did that and did it for over a decade, called interest on excess reserves. That's as close as they got to make it. Don't worry about repurchase agreements. Those are repos. There's also reverse repos, and don't worry about that. All right. That looks like it, folks. All right. Thanks for hanging in there. This may have been a little longer than you wanted, but we got through it, right? All right. Be good. Be kind. Be safe as always. And I will talk to you next when we look at policy applications. All right. Thanks, folks. Appreciate your time.